Welcome back. I'm John A.G., and today we're not doing a headline recap. We're doing a pressure test, the kind where you look past the shiny surface and ask one brutal question. What happens when a country's markets start screaming, everything's fine, while its currency and bond market whisper, something's breaking? Because Japan right now is putting on the cleanest mask in global finance. Stocks are ripping. The index is printing numbers people used to treat like science fiction, and on your feed it looks like a victory lap. But under that, the yen is sagging, the debt is enormous, prices are rising, and the bond market, quiet, boring, ignored, may be flashing the kind of signal that only shows up before the story turns. Subscribe right now and drop a comment, even OG is enough, so the algorithm knows you actually want more of this. All right, let's set the frame. Japan can look okay if you only stare at equities, if you only watch the ticker, if you only measure wealth in stock points. But economies don't live in a single market. They live in the plumbing. Currency confidence, government funding, real purchasing power. And here's the twist. Japan might be the first domino, not because it's the weakest country on earth, but because it's the most advanced case study in the modern playbook. Long-term near-zero rates, non-stop rescue policies, giant central bank balance sheets, and a government that can't tolerate pain. If that sounds familiar, it should. Because a lot of the West has been copying this playbook for years. Japan just started earlier, stayed longer, and pushed it further. So today, I want to walk through a simple storyline that's getting louder. Booming stocks, plus a weakening currency, plus stressed bonds, plus giant debt can create a dangerous kind of everything bubble moment. Not a normal inflation cycle, a confidence cycle, the kind that can flip fast. And I'm bringing in someone who lives inside this world of rates, money, and market psychology. Someone who watches the bond market the way most people watch sports scores. Joining me is a macro strategist and former rates trader. We'll just call him David today. No drama, no guru worship, just a clean breakdown of how this machine works. David, good to have you here. Thanks, John. Good to be here. All right, I'm going to start with the surface because that's what everyone sees. Japan's equity market has been on a tear. It's been described as running hot. We saw it above 40,000, then a sharp drop toward 30, and now it's being talked about around 57,000. When a market does that, people want one sentence. They want Japan is back. But you and I both know a market can be up for very different reasons. So let's ask the uncomfortable version. Is this strength, or is this a stampede out of something else? That's exactly the question. When equities surge at the same time the currency weakens and bond yields rise, you have to consider that stocks are being used as a lifeboat, not a celebration. And here's the part that trips up even smart investors. A soaring index can be a mirage if the measuring stick is shrinking. If the yen buys less, the same company can look more valuable in yen terms, even if the real-world output hasn't changed much. Nominal gains feel great. Real gains are what matter. So when you see Japan's market sprinting, ask, sprinting against what? Against the yen? Against imported energy? Against a basket of global goods? Because if the currency is sliding, the scoreboard is tilted. Now, I can already hear the counter-argument. But companies can benefit from a weaker currency. True. Exporters can see revenue translate into more yen. Profits can rise in local terms. Stocks can go up for fundamental reasons too. The danger is when the rally stops being selective and starts becoming a blanket bid. When everything is being bought because holding cash feels like a guaranteed loss. And that's why I keep coming back to bonds. Bonds are the part of the system that has to work every single day without applause. Every auction is a tiny referendum on trust. Every yield move is a message. When that message starts getting louder, it forces a response. Here's a cliffhanger that most people never think about. What happens the first time a government bond auction clears, but only because the central bank quietly becomes the buyer of last resort again? The headline will still say, auction successful. The market will know the difference. And if you're wondering why that matters, it's because once a country is perceived as financing itself through permanent support, the currency can start behaving differently. Not immediately, not in a straight line, but with a new kind of nervousness that creeps into every price tag. That's when households stop comparing prices and start comparing time. If I wait, will this cost more next month? That one question can shift an entire nation's behavior. And once behavior shifts, the charts catch up, usually too late for most people to react calmly and rationally. Yeah, because if you're holding the currency and you feel it slipping, you don't sit there calmly. You start looking for exits. And the exits are almost always the same. Hard assets, foreign assets, real businesses, anything that can keep up when cash can't. So let's walk through why the yen matters here. There's this narrative that it hasn't dropped that much. People look at a move and shrug. But the longer you zoom out, the uglier the trend looks. Historically, Japan had long periods where the yen strengthened. There was an era where the dollar could be several hundred yen, and then over time the yen gained, the exchange rate compressed, and by the late 80s it looked like Japan was unstoppable. But the more recent era has been different. Since the big policy shift, call it a new stimulus regime, the yen has trended the other direction. And if you're sitting in Japan watching imported costs rise, you don't need a PhD to feel what that means. You feel it at the register. Exactly. Currency weakness isn't just a chart, it's a tax. It's a slow drain on purchasing power. It shows up in food, fuel, household staples, things people can't easily substitute away. And this is where the political part starts. Because when the average person starts feeling squeezed, governments respond. Not by tightening, usually by doing more support, more relief, more spending, which, ironically, can add more pressure to the currency. So let's talk debt. The number that gets thrown around is public debt around 252% of GDP. That's gigantic. Even if you don't argue about the exact measurement, the direction is clear. Japan is running an extreme case. And here's the key. High debt is not automatically fatal if your funding is stable. The danger shows up when funding costs rise. And funding costs rise when bond yields climb. Right. A high debt load is like a heavy backpack. You can carry it if the ground is flat, but if the hill gets steeper, if interest rates move up, suddenly the same backpack becomes unbearable. And people underestimate how sensitive Japan is to that. Because Japan has lived in a near-zero world for so long that the public almost forgot what rate risk feels like. Let's pause there, because this is one of the most misunderstood mechanics in global finance. Japan's low rates didn't just affect Japan, they fed a global strategy, the yen carry trade. Explain it like we're talking to someone who's never heard that phrase. Sure, the carry trade is basically borrowing in the currency with the cheapest interest rate. If Japan keeps rates near zero, borrowing yen is cheap. You borrow yen, you sell the yen for another currency, dollars, euros, pounds. Then you use that money to buy assets that you think will return more. Stocks, bonds, credit, property, anything with yield. The profit comes from the spread, low funding cost, higher return elsewhere. And there are two risks. One, rates in Japan rise. Two, the yen strengthens, because then your loan becomes more expensive to repay in your home currency. Exactly. So the whole system quietly depends on Japan staying easy. It depends on Japan staying low rate and stable. And when that stability gets questioned, carry trades can unwind. Now, here's where it gets spicy. Japan has started nudging rates up, but they're still extremely low, below 1%, often described around 0.75%. At the same time, inflation in Japan has shifted. For years, policymakers talked about deflation like it was a monster under the bed. But recently, prices have been rising more consistently. Think roughly 3% territory, not the old zero world. So if prices are rising and rates are still near zero, what does that mean? That's negative real rates. It means savers are losing purchasing power. It means holding cash and short-term safe assets feels like watching your money melt. And when people feel that, they don't sit still. They start taking action. Now we get to the bond market. In this script, the claim is that the Japanese government bond market has been under pressure. Prices down, yields up. And there's also this striking idea that the central bank owns a massive share of the outstanding bonds, sometimes described as about half. If yields rise in that environment, what happens to the government? Interest expense climbs. And with debt that large, even small rate moves can change the budget math fast. Right. And that's where the doom loop concept shows up. Higher yields mean higher interest expense. Higher interest expense means larger deficits. Larger deficits mean more issuance. More issuance can push yields higher. And all of that can feed back into currency confidence. Now, to be clear, this doesn't mean collapse tomorrow. Markets don't work like cartoon explosions. But it does mean fragility builds. And fragility is what matters when sentiment shifts. Let's talk about the money printing part, because people throw that phrase around. But in Japan, it's not just vibes. There's a story of continued bond buying and liquidity support. The numbers thrown around here. Ongoing purchases described as about 200 billion yen per quarter, stretching out into 2027, with a recent taper from around 400 billion earlier. Now, we're not verifying these exact figures today, but the concept is what matters. Continued support, long horizon, slow exit. And if the central bank is still injecting, where does that liquidity tend to show up? Assets, especially equities. Because when bonds are unattractive and cash loses purchasing power, people chase the thing that looks like it can outrun the erosion. So you get this weird picture. Stock market up looks like prosperity, but it can also be a symptom of escape. Yes, and this is where the crack up boom idea gets invoked. Not as a meme, as a psychological phase shift. It's basically the moment when the public stops believing the currency will hold its value. Not just, inflation is annoying, more like, I don't trust this money long term. And when that trust breaks, behavior changes. People rush to convert money into goods, assets, anything tangible, sometimes regardless of price, because holding cash feels like holding a melting ice cube. Right, that's the heart of it. The scary part is not inflation itself, it's the belief that it won't stop. And historically, that belief shift can move faster than policymakers expect. Now, I want to connect this to something that's easy to visualize: gold priced in yen. Because gold isn't just an investment in this narrative, it's a measuring stick. It's the yardstick for currency debasement. The script points to gold and yen rising dramatically over time, moving from levels like 30,000 yen per ounce in earlier decades to the hundreds of thousands, and into territory people describe as heading toward a million. Whether you love gold or not, that chart is telling you something. The yen's purchasing power against hard assets has been sliding. And if you're a household in Japan, watching that, you start thinking, what am I supposed to do? Keep savings in cash? Keep it in low-yield bonds? That's where the anything except the yen instinct comes from. Again, we're not using that phrase as a slogan. It's a behavioral observation. People rotate out of the thing that's losing confidence. Now, let's bring in the political piece, because politics is where the economic pressure becomes policy. There's mention of a new prime minister, described as a woman, calling a snap election and doing very well. The implication is she has a mandate, and she's likely to push more stimulus-style policy, more growth support, possibly tax relief on essentials like food. From a human perspective, that's understandable. People feel squeezed. Governments respond. But from a currency and debt perspective, what can that do? It can reinforce the same cycle. More spending can mean more deficits. More deficits can mean more reliance on central bank support, and that can keep pressure on the currency. Right. It's the tragedy of short-term politics. The policies that reduce pain today can increase fragility tomorrow, and Japan's been living in that trade-off for decades. Let's rewind briefly to the origin story because it matters for the psychology. Japan had a major bubble era that ended around the late 80s. When that burst, banks were under stress, markets fell hard, and policymakers stepped in with rescues. Over time, that morphed into a system where the economy was constantly supported. Bailouts, stimulus, ultra-low rates. That's when people started talking about zombie institutions. Firms and banks kept alive not by real productivity, but by cheap money and ongoing support. And here's the part that makes Japan relevant to everyone else. It became a template, a preview. Because when the West faced crises, financial crashes, big shocks, policy leaned in the same direction. Rescue first, pain later, and later never quite arrives. So when someone says Japan could be the first domino, they're really saying Japan might be the first major developed economy where this long experiment reaches a visible breaking point. And if it happens there, it changes psychology everywhere. Now let me ask you a pointed question, David. If you had to pick one market to watch, one signal that tells you whether this is just a normal cycle or a deeper confidence problem, what is it? I'd watch the bond market and the currency together. If yields are rising in a disorderly way while the currency weakens, that's a red flag. If it's controlled and the currency stabilizes, you can argue it's a managed adjustment. But if both start moving against policymakers at the same time, it forces choices. And those choices are never comfortable. You either let yields rise, hurting the budget and the economy, or you suppress yields, risking more currency weakness and more inflation psychology. Exactly. It's a policy fork. And here's where retention matters, because people think the story ends with Japan is doomed. It doesn't. The more accurate statement is Japan is approaching a decision zone, a zone where the trade-offs get sharper, where the old tricks have diminishing returns, where every policy move has a cost. And that's why the stock market rally is not automatically good news. It might be a signal that money is rushing to the last place it feels real. Now, before we go further, I want to do a quick sponsor moment because it fits the theme we're talking about: wealth protection in a world where rules and risks can shift. If you keep valuables at home, documents, metals, backups, anything you would hate to lose, consider upgrading your physical security. We've partnered with a home safe provider we trust, and there's a discount link in the description if you want to check it out. No pressure, just an option. All right, back to Japan. Let's talk about the emotional trap of a soaring index, because headlines love big numbers. Nikkei at 57,000. That line travels. But big numbers can be two things. They can be genuine growth, or they can be a mirror reflecting a weaker unit of measurement. If the currency is losing value, the same real asset can be priced higher in nominal terms. That's why looking at stocks alone can mislead you. So the question becomes, are Japanese companies suddenly producing dramatically more real value, or are investors simply trying to get out of cash and bonds? And the honest answer can be both. But the proportions matter. Right. And you can often see it in the sectors leading the move, the volume and the behavior of domestic savers. In some cycles, it's foreign money chasing performance. In others, it's locals moving savings into equity because the alternative feels worse. And that's where the Mrs. Watanabe idea comes in, this archetype of the everyday Japanese saver trying to protect family savings in a low-rate world. When rates are pinned low and prices rise, the saver becomes the donor. The system is effectively transferring purchasing power away from cash holders. So if you're that saver, you start hunting for protection. Gold, foreign currency assets, dividend stocks, anything that feels like it won't be confiscated by inflation. Now, another point from the raw script, it suggests that authorities used deflation fear as cover for years of policy expansion because consumer prices were flat or occasionally negative. This is important because it shows how narratives change. In one era, deflation is the excuse. In another era, inflation is temporary. In a third era, it becomes manageable. But markets don't care about the story. They care about outcomes. And outcomes are what households feel. So if households feel the cost of living climbing while their bank yields stay tiny, their behavior changes. And if behavior changes broadly, that's when the psychology can tip. Now, let's address the scary term without sensationalism. Crack-up boom. People hear that and think it means instant collapse. But conceptually, it's about a scramble, the rush to exchange money for real things because people don't trust the money. And historically, when that dynamic starts, it feeds on itself. Prices rise because people are spending faster. People spend faster because prices rise. And confidence breaks because the cycle looks unstoppable. And one of the key ideas from Austrian economics, paraphrased, not quoted, is that once the public believes the printing will continue without restraint, the currency stops functioning as a stable medium. So the question isn't, is Japan there today? The question is Japan moving closer? The raw script stance is, yes, Japan is getting close. Now, I want to stress something for the viewer. We're not saying you should panic. We're not saying sell everything. We're not giving personal financial advice here. What we are doing is mapping the structure, the incentives, the bottlenecks, the points where a system can flip. Because if you understand the structure, you won't be surprised when the headlines catch up. Let's zoom into the bond market again, because bonds are where confidence becomes math. When yields rise, bond prices fall. That matters for anyone holding them. And it matters for the government because new borrowing becomes more expensive. Now add the central bank's heavy involvement. If the central bank is a dominant buyer, the market can look stable until it doesn't. And if the central bank tries to step back while inflation is present, yields can push up. But if the central bank steps back too far, it risks disorder. If it steps back too little, it risks currency weakness. So the system oscillates. Tighten a little, support a lot. Calm the market. Then the pressure returns. And what we're seeing in Japan is an extreme version of that oscillation. Exactly. And because Japan is so large and so connected, any instability there can spill into global markets through carry trades, through risk sentiment, through funding channels. If the yen carry trade unwinds, it can force selling in the assets that were funded by yen borrowing. That can ripple. That's why Japan isn't just a local story. So when you see Japan stocks soaring, don't just think Japan bullish. Think global funding conditions. Now, let's go back to the timeline moment that people ignore. There was mention of a sharp equity drop, then a rapid rebound after authorities stepped in. That pattern, fall hard, then policy backstop, trains investors to believe the floor is permanent. And that belief can push risk-taking even further. But here's the cliffhanger. What happens when the backstop starts to weaken? Not because policymakers want it to, but because the currency and bond math start to constrain them. That's the danger zone. Now, David, I want your take on the not healthy comment. When someone says this isn't healthy, what do they usually mean in market terms? They usually mean the move is being driven by policy distortion rather than fundamental earnings power. It can mean valuation stretches, it can mean volatility increases, it can mean the rally is a symptom of monetary conditions, not productivity. And in Japan's case, if the rally is partly a response to currency debasement and negative real yields, then it's not healthy growth. It's adaptation. It's defense. Right. Defensive investing can still create a booming chart. That's the tricky part. Now, let's talk about the human side again, because virality lives in the human side. Imagine you're a working family. Your wages are not skyrocketing. Your groceries are more expensive. Energy costs are up. Your savings account yields almost nothing. Your government says it's under control. Then you look at the stock market, and it's exploding upward. And the people who already own assets get richer. And the people who don't feel left behind. That's how social pressure builds. And that's why political promises appear. Tax cuts on essentials, new stimulus, more support. But here's the cliffhanger inside the cliffhanger. Every relief measure has to be funded. So either you raise taxes elsewhere, or you issue more debt, or the central bank absorbs more. And all of those routes can lead back to the same problem: currency confidence. Now, the raw script compares Japan to historical cases like post-war Germany and revolutionary France, and it also mentions early American currency failures. The point isn't to say Japan equals those. The point is to highlight a pattern. When debt and money creation go too far, confidence can snap. And the snap is psychological before it's mathematical. So even if numbers look manageable on paper, confidence can outrun the spreadsheets. Now, I want to put you on the spot with a question viewers will care about. What would you watch to know if a confidence snap is approaching? I'd watch 3 things. 1. Currency acceleration, when weakness speeds up, not just trends. 2. Bond market disorder, when yields jump and liquidity dries up. 3. Behavioral signals, rising demand for hard assets, capital controls chatter, or unusually aggressive policy responses. When those cluster, you're closer to a confidence event. Yeah, and notice what you said there, clustering. That's how these episodes happen. It's rarely one data point. It's a convergence. Stocks ripping alone is not proof. Yen weakening alone is not proof. Yields rising alone is not proof. But when they start moving together, you get a narrative that can harden fast, get out of cash. And when that narrative spreads, it can become self-fulfilling. Now here's what makes Japan uniquely interesting. For decades, Japan has been the example people used to say, see, you can print and nothing bad happens. Japan became the counter-argument to inflation fears. But now, the same Japan is showing signs that the costs are arriving. Not all at once, not in one dramatic day, but in the form of purchasing power loss, bond stress, and a currency that keeps drifting. And when you see gold priced in yen pushing toward levels like 1 million yen per ounce, people interpret it as the currency's report card. Again, you don't have to be a gold bug to understand the signal. It's the mirror. Now, I want to bring it back to the viewer with a simple thought experiment. If you had to hold your life savings in one of 3 things for the next 10 years, cash in a weakening currency, long-term government bonds with rising yields, or ownership in productive assets, what would you choose? That's the decision Japanese savers have been pushed toward. And it's the decision many Western savers may face next. And that's why this matters beyond Japan. Now, let's address the potential objection. But Japan has been doing this forever. They always avoid collapse. That may be true, until it isn't. And that's not doomsaying. That's just how risk works. The longer a system avoids adjustment, the larger the adjustment can become when it finally arrives. So the question isn't, can Japan keep going? The question is, what price will Japan pay to keep going? Will it be slower growth? Will it be a weaker currency? Will it be higher inflation? Will it be tighter controls? Those are the trade-offs. And if a new government doubles down on stimulus-style policy, the trade-offs don't disappear. They just shift. Now here's another cliffhanger I want you to sit with. If the yen keeps weakening, imported inflation persists. If imported inflation persists, public anger rises. If public anger rises, policy becomes more aggressive. If policy becomes more aggressive, debt grows. If debt grows, bond math worsens. And if bond math worsens, the central bank is pulled back into the market. That loop is what people mean when they say end game. And the only way out is either real growth that outpaces the debt burden, or a restructuring, or a monetary reset, or some combination. None of those are painless. Now I want to ask the audience something, because this is the kind of episode where your perspective matters. Do you think Japan's stock surge is real prosperity, or a flight from the yen and bonds? And second question, if the yen carry trade unwinds hard, what do you think it hits first? Global stocks, crypto, commodities, or something nobody's watching? Drop your take in the comments. I read them, and they shape what we cover next. David, I want to give you the last word. When you look at this whole picture, stocks, yen, bonds, debt, what's the most underrated part of the risk?
The underrated part is timing. People assume if a risk is real, it must happen quickly. But structural risk can build slowly, then reprice violently. The boring years are when leverage and complacency pile up. The event is just the release valve. So if you want to be early, you watch the slow build. If you want to be safe, you don't wait for the headline panic.
Yeah, that's the lesson. Japan might not be the end of the world, but it might be the first clear demonstration of what decades of rescue policy can do to a major currency and bond market. And if Japan is the first domino, the second domino won't be a small one. So keep your eyes on the yen, keep your eyes on Japanese bonds, Keep your eyes on gold priced in yen. And most importantly, keep your eyes on confidence, because confidence is the one thing you can't print. All right, that's it for today. Subscribe if you haven't, and if you're still here, comment OG so I know you made it to the end. See you in the next one.